Hey everyone, it's Brandon from the Young Investors Podcast. Myself and Hamish are excited to bring you your weekly rundown of the latest business and investing news from around the world. A quick reminder before we get started that any advice provided by myself is general and does not consider your financial situation, needs, or objectives, so consider whether it's right for you. Brandon Kolk is authorised to provide general financial product advice in Australia and is authorised representative 1305795 of Guideway Financial Services Proprietary Limited, AFSL 420367. Please see the description box for my financial services guide. Past performance is not a reliable indicator of future investment returns, but with that said, let's get into another episode of the Young Investors Podcast. Alright guys, welcome back to yet another episode of the Young Investors Podcast. I'm joined as always by that guy that you know as Hamish Hodder.
That guy.
Who's got an absolute ripping video out at the moment. How's it going, mate?
Yeah, the video is doing good. Yeah, I was telling you, it's so funny. Like you do one type of video where like the previous video that I did was maybe, I reckon 40 hours of editing. Like it was like this intensive research video, 2 weeks. And it did pretty well. Like it's a fine video. But then this video was more of just like covering a little bit of news that happened over the weekend. So I kind of put it together in a couple of days. And of course, this is the video that's doing incredibly well. It's like the news topic video that's got recession in the title that takes 2 days, does that, versus like basically a mini documentary that I spent 2 whole weeks making. But that's the game.
Think of the long term, Hamish. Think of the long term. The other videos will win out in the long run.
Yeah,
this one will die.
That is very true. And that's exactly why I've enjoyed what's part of the reason why I've really enjoyed making these kind of historical documentary videos, because at least when I put 2 weeks of work into it, I get a sense of satisfaction knowing it's kind of on my like YouTube shelf, and it'll be there and it'll be relevant for, in 2 years, 3 years, 5 years from now. So, yeah. Yep.
I remember you telling me like last year, the year before, you feel like you still hadn't quite found your place in the niche of finance content. Yeah. And I feel like you're starting to get closer to your niche now. Of course, it always evolves, I guess.
It does. And I think I've just really, I've always enjoyed making finance content, but these particular types of stories I find really, really interesting. And so I finally found like a type of video that I'm really excited to make versus just like I'm interested in finance and I'm going to cover what I think is kind of happening, I guess, is the way that I would put it. But you're definitely right.
But then the news ones do well, and that's pretty much what we've got today for you. We got a bit of a shorter podcast because we're pushed for time because we are going to the Formula One. We are both in Melbourne. It is Grand Prix weekend, and we are going to go watch the Australian Grand Prix.
Vroom.
Yeah, exactly. Yeah, toot toot. Exactly right. Said like a true motorsport fan.
Yeah.
Oh, wow. Did you see how that one went vroom and then that one came through and it went vroom? But it kind of worked out well because there only is one financy topic to really talk about this week, or one main topic, and that being this mini market crash that we're seeing, Hamish. I don't know if I'd quite put it so far as to call it a mini market crash, but it certainly is in correction territory. And if you've seen any sort of finance media, mainstream media over the last couple of days, you would have seen all of them talking about Donald Trump and tariffs and recession fears, and the stock market has come down quite a bit as well. So that's going to be the topic of the whole podcast today. That's what we're going to be talking through, talking through basically what's going on, why it's happening, and what we should do about it. So hopefully it's a reasonably well-rounded podcast.
Yeah. All right. Well, with that said, today's episode is brought to you by Seeking Alpha, your one-stop shop for stock analysis, market data, and news. Access expert analysis and news from thousands of stocks. View buy, hold, and sell ratings from members, Wall Street analysts, and Seeking Alpha's own algorithm. Screen for stocks using a variety of fundamental and technical analysis metrics. Access 10 years of financial data and company filings, and manage your portfolio by tracking your investments with price alerts so you never miss a buying opportunity again. Click the link in the episode description or head directly to seekingalpha.me/young investors to try Seeking Alpha free for 7 days. Do you want to kick it off by just explaining what was the kind of the reaction to markets at the beginning of the week?
Yeah.
And
I'll tell you what's
everything?
happened first, and then we can kind of explore the why, which I think I'll leave more in your court because, as you said, you made a brilliant video about it. What's happened is a bit of a mini bloodbath, and it's really been happening over the past few weeks. For some stocks, it's kind of been this whole year. But for most stocks, it was kind of around the 19th, 20th of February that things started to turn south.
Yep.
And I guess the reason that it's making news now is that it's continued to go south, and we're now at the 13th of March as we record this. And, the hole's getting a little bit deeper. So that's why you kind of get all the finance media chiming in and talking about it. So what we're looking at is the S&P 500, collection of the 500 largest stocks in America, down 9% now since February 19th. And 9% doesn't sound like all that much, but when you're talking about a collection of 500 large American companies, that's to take them all down on average by 9%, that's quite something. The NASDAQ is even worse. So the NASDAQ, as opposed to, say, the New York Stock Exchange, is more biased towards American technology companies, I would say. Do you feel like that's a fair representation of the NASDAQ?
It's certainly not all tech companies, but it does definitely has that bias for sure, yeah.
Yeah, so that one's actually fallen further than the S&P 500. That's down 12%. So we're seeing a decent. It's nothing, that's going to crush you as an investor, but it's something that definitely makes you pay attention. And then we can have a look at some individual stocks, namely the Magnificent Seven. Some of those stocks are really getting hammered as well. Most notably, I think, would be Tesla. That's the one, obviously, with Elon Musk and his politics at the moment. He's always making news. But Tesla's down 30%. Since February 19th. Nvidia is another steep loser, down 17%. Meta is down 16%. Amazon down 12%. Apple down 11%. Microsoft down 8%. So some of these really big technology companies in America are feeling decent bites being taken out of their market caps.
Yeah.
A lot of people are calling this the start of the stock market crash, and it really has kind of swept through stock market media at this point. Yeah. Seems that what was just a few months ago ultra just greed in the market and euphoria is reasonably quickly turning into a little bit of fear.
Yeah, and I mean, in this week particular, most of it was on Monday. So as soon as the market opened, which tells you a little bit about the why already, because it was kind of stuff that came out over the weekend. But most of it was on Monday. Right. There was a little bit on Tuesday, and then we're recording this after the Wednesday session just finished, and Wednesday was positive. So I mean, things are kind of rebounding, and obviously, we have no idea what's going to happen between now and when we
subject to change
when we release this episode. But yeah, it was certainly quite a negative couple of days to start the week. Which was
so I think that's kind of the setup. We don't need to waffle on the setup too much. I probably did waffle on a little bit already. I'm kind of interested more in the why. Like, why has this? What's the media putting it down to? What are investors worried about? Where's the fear coming from? And this is kind of what your YouTube video was about, like the why as to this mini stock market correction.
Yeah, and I should preface maybe before I even get into this that when we talk about this why, it's not as if from a long-term investing perspective, this is something we should necessarily care about. But this is kind of just more of an explanation of why markets reacted that way, rather than trying to implying that this is something that we should be reacting to in our portfolios or anything like that. So I just wanted to say that up front. But as I said, so that the markets kind of opened on Monday quite negative, and so it was pretty obvious, even just from looking at that something over the weekend had happened, and there was actually a couple of things that kind of compounded together over the weekend that kind of combined to result in what happened come Monday. The first thing was Trump did an interview with Fox News, and they spoke obviously about his policies and his trade policies and the economy. And at one point, he was essentially point blank asked whether he thought the US was going to head into recession as a result of his kind of tough stance on tariffs. And part of his response was a phrase that you probably have seen in a bunch of headlines, which is there will be a period of transition. And essentially, while that is kind of vague, and it's not necessarily him saying, yes, there's going to be a recession, the way that markets have viewed this is essentially, A, tariffs are going to be staying and they're going to be going up, and these trade wars are going to be escalating. And B, he's going to continue doing that regardless of how it impacts the economy. So regardless of whether, let's say inflation starts to pick up a little bit more or economic growth slows down, it sounds like he's very, he plans on sticking on this track of raising these tariffs. And so that was kind of the main, I think, thing that then got kind of thrown into, obviously, the media through a bunch of headlines and such.
It's kind of funny. We're going to have the best stock market. It's going to be the golden age of America. You might get tired of winning. We're going to win so much. But there will be a transition period. Yeah. And we might have a recession also. I didn't mention that part.
Yeah. It is kind of funny. But yeah, I think, I guess you kind of said it as well. But at the beginning of all of this tariff stuff, it was, and I mean, I guess still now, we just don't know whether they're going to stick around. Like, are they going to, where are the tariff levels going to be? Are they going to be changed next week? And, every day I look at the news and I search US tariffs, and there's this tariff went up, this one was paused, this one was renegotiated. And so nobody really knows. But the markets are starting, I guess, to see, even though we don't really know where they're going to be, the uncertainty has reached a level where it's enough to react in markets for some people, I guess is the way that I would put it.
Yeah, I don't want to get too far off topic and distract the conversation, but I saw a really interesting argument the other day that I just wanted to mention, how people were saying, revolving around Trump's tariffs, because he's kind of chopping and changing, you know how he wants to bring manufacturing back to America? That's like the whole reason we're going to put these import tariffs on, so that, imports become from other countries, from low-cost producers, become ineffective. We want to bring the manufacturing back to America, American domestic industries, and blah, 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 blah. Well, there's a good argument going around that, nobody really knows what the heck is going on because he's chopping and changing so much that if you were, I saw this in an Atrioc video, if you were a big importer sitting in America and you import a lot of products, are you actually going to start messing around with, maybe we should change our manufacturing here or there, or should we start manufacturing in very expensive America? You're probably not going to, considering how you're probably just going to be like, well, can we kind of just wait and see whether this actually goes through?
Yeah.
And chances are, are you really going to make that massive change in your supply chain when maybe in 4 years' time, these tariffs just get chucked out by the next administration?
Yeah.
So it's kind of interesting. He's arguing so much, we're going to do this, America first, bring it back to America. And then at the end of the day, it might not even do that at all.
Yeah, exactly.
Because companies will just sit there.
Are you really going to spend all of this money to move manufacturing back to America? Then they're gone. And then now,
for 4 years or something.
Yeah, and now you're at a massive disadvantage to all the other firms who are still producing overseas at a lower cost.
Yeah.
And so,
but anyway, sorry, I derailed you there a little bit, but yeah, that's exactly right.
No,
but sorry, I'll chuck it back to you.
You're exactly right. And so that was kind of the main. That was like the trigger point, I guess. And then from that, after the interview, one thing that you saw was a lot of big investment firms changing their economic outlooks for the US. And it's, those economic outlooks that then a lot of investment firms kind of use to make decisions in the markets. And then they, have reacted at the beginning of the week. as I said at the beginning, do we care about these forecasts? Not really. I like covering them because I think they're interesting. But it's not like I'm, looking at this and going, wait, so GDP is only going to grow at 2% now? Oh, I better sell 4% of this stock. And there's no investment decisions.
The reason we bring it up is because this stuff does have an influence on people trading the market and the ultimate market levels. It doesn't mean anything for long-term investors, but it does actually influence the price of stuff going around.
Exactly. Yeah, exactly right. And so the first big one we saw was from Goldman Sachs. So first their December outlook. So at the end of each year, they provide an outlook, obviously, for the whole year. So in December, they thought that real GDP growth would be 2.5%, and inflation was approaching 2%. So everything was kind of la-di-da. They did note one risk factor in this outlook, which was the biggest risk, this is a quote, the biggest risk to our outlook is how much of a tariff increase the Trump administration will impose. And so over the weekend, they updated their outlook. So they now think GDP will only grow at 1.7%. And they were quoted saying, we now see the average US tariff rate rising by 10 percentage points this year, twice our previous forecast, and about 5 times the increase seen in the first Trump administration. So given what Trump has said, and also the development of other tariffs over the weekend and retaliations and that sort of thing, they now have essentially changed their view. They have a much more negative view of the economy based on those increased tariffs. And a part of that is that they also see a re-acceleration of inflation. And so that's kind of their view. And then we got JP Morgan also updated their outlook over the weekend. Their outlook, they didn't provide, or at least from what I saw, I didn't see an update in terms of GDP and inflation, but they do provide a probability of recession, which, again, I kind of think is a silly kind of metric for them to to have, but they do it. And essentially, their previous probability of an inflation of a recession in 2025 was 30%, and they've now increased it to 40%. So it's almost a coin flip. But yeah, I mean, I don't really know how they get to that percentage. So
it's probably just Jamie Dimon.
They just call up Jamie. What do you reckon?
What do you reckon, mate?
30%. No. Make it 40. Well, let's go 35.
It's a hurricane.
It's an economic storm. Yeah, it's coming. Yeah. And their kind of quote on this release was, we see a material risk that the US falls into recession this year owing to extreme US policies. Policies. And so
kind of the same thing though, really.
True. So those were the two big ones. We also saw other firms like Morgan Stanley jump on board as well. And then, as I said, on Monday, we saw the markets react to this, which, as a long-term investor, you probably shouldn't react to this. But not everyone participating in markets hold a long-term view. Shockingly.
No, that is true. I would say most of the market has a quarterly view.
Yes, exactly. Yeah. And so those were the kind of the I would say the main like quote unquote negative things that impacted the market. We also got some more neutral and I don't know, like a more based perspective from Jerome Powell, who had a speech over the weekend. And kind of spoke about the economy, but gave us a bit more of a neutral perspective. And you could take his neutral perspective as he doesn't want to make any ripples or anything. But I also think his view is actually probably quite a reasonable and balanced view of what's happening anyway, versus some investment firms that are, saying things look quite dark. And then you have, news outlets obviously fueling that and so on. So we got this speech. He actually sees the economy in good condition. He mentioned low unemployment. Other labor market indicators were all pretty strong. Inflation is still low. PCE is just 2.5% and trending towards the 2% target. Still decent economic growth. So the economy grew at a real rate of 2.3% in Q4 of 2024. That's an annualized rate of 2.3%. So still pretty decent. He did mention some concerns. There were household surveys indicating that Americans are feeling a heightened level of uncertainty, which is kind of what we were saying before. No one really, and this applies to businesses as well, nobody really knows where these impacts, what the impacts are going to be from these tariffs and where they're going to sit. And so there's a little bit of heightened uncertainty, as he said.
Yeah,
as he mentioned, and I think that was essentially it. In terms of what he thinks we should expect, he said that there could be some economic data points in the next few months that look bad, but to emphasize that doesn't necessarily mean they will persist. And that, again, it comes back to the fact that we don't know where these tariffs are going to sit. We might see some businesses raise prices in reaction, but then the tariffs might go away or they might lower prices. And so nobody really knows. But even if there are some spikes of inflation and slower growth in the next couple of months, he was essentially saying people shouldn't be overly concerned about it.
Yeah, I actually quite liked that speech from Jerome Powell that he gave the other day. It was, sometimes it was a little bit fluffy because he basically tried to say nothing.
Yeah.
But it was reasonable. Like, he still laid out the groundwork. He said, "Look, we're just watching what's going to happen. Things are okay at the moment. Where inflation might come back, so we're holding policy where it is." And then if inflation spikes, we won't hesitate to raise or hold interest rates where they are.
Yep.
But we don't know what's going to happen, so we'll just have to wait.
Yep.
It's like pretty fair and reasonable.
Yeah, pretty classic Jerome.
Yeah, it is classic Jerome. You could have taken that excerpt and say which speech is this, and you wouldn't have been able to tell from the last 10 that he's given. It's all the same. Yeah, but I think it just overall, the Federal Reserve's starting to talk about it. People are starting to wake up. People are just starting to understand that this tariff plan is probably not brilliant in the near term for the economy. They're going to make prices higher for Americans. The consumer's going to suffer, but they will also cause the disruptions to global supply chains.
Yep.
So higher prices, lower business output.
Yep.
Reduced demand from higher prices, lower profitability, supply chain disruptions.
Yep.
Lower production for a while if people do have to start changing stuff with the supply chain. It's not great. It's not a great near-term thing for the economy.
Yeah, I think the one useful thing for tariffs is just you can kind of use them to just apply a bit of pressure to get, to negotiate potentially, in specific circumstances. But you're right, the economic, consequences are pretty clear on this. It hurts both countries that, the country imposing and the country that it's imposed on. And so, yeah, it's pretty clear on this.
Did you hear one thing I picked up, Jerome? This is when Jerome was trying to say that the tariffs are going to be bad for inflation, but he didn't want to say that. He didn't want to actually say those words. Yeah. So it was pretty funny. He said something along the lines of, with these trade policies, we think it's going to just look like what the textbook would say.
Yeah,
So it's pretty much just saying,
pick up the textbook.
Go and read an economics textbook, pick it up, turn to the page that says import tariffs, and then read it, and that's what will happen, which is inflation.
Go sit in on your local microeconomics, microeconomics 101 class, and go look at the graph.
Yeah, exactly right.
Yeah.
But so I guess that's kind of a good round kind of discussion of what's causing the stock market downturn. Do we have anything else to add on that topic before we move on into what we should do about it?
No, I think that's just about it. I'm sure between now and when we upload this in a day or so, there's probably going to be 10 other new tariffs added, 10 ones removed. So unfortunately, with covering this stuff, there's always new developments. But yeah, that's what's happened.
That's where it stands at the moment.
Yeah.
Yeah. So I guess the last part of this podcast, what I thought might be helpful is just us, Hamish, having a bit of a discussion on on what we kind of should be doing as long-term investors during time periods like this. And spoiler alert, I think everyone that's been listening to us for a long kind of period of time will already know what we have to say, but we're going to say it anyway. God damn it. This is our podcast.
Sell everything. Is that what it was? Sell everything and buy Trump coin, I think. It was Melania coin, I think.
Yeah, Melania. Yeah. I like Melania coin personally because the graphics, it like looks a little cooler. So I think that gives it more intrinsic value.
Yeah. More letters in the coin ticker as well.
Yeah.
That counts for something.
Exactly. Yeah.
It's like,
although that does increase costs because the amount of pixels they have to light up. Yeah. So, Anyway, it's tough. It's complex. I won't get into it now, Hamish. I'll explain it to you later. But no, it's obviously it's easy to get swept up in panic. I've felt it the last couple of days, Hamish. I don't know if you've looked at your portfolio in the last couple of days. It's easy to open it up and be like, whoa, I had more money yesterday than I do today. So it is easy to kind of, especially when all the media's selling fear, it is easy to kind of really feel that.
Yeah.
But whenever we go through little periods like this, I always just go back to kind of what Warren Buffett would say. And I think we can kind of guess what he would say. And he'd be looking around for bargains. He wouldn't be worried that the stock market's going down. It's you have to treat these things as opportunities. You have to kind of put aside your emotions. I mean, the stock market tanks very, very infrequently. And what we are looking for as investors are those rare moments when, either an event hits a specific company or it hits a sector. Maybe it's a sector thing like air travel in COVID, or, when it hits the entire market. You could also argue that COVID hit the entire market. And what we're getting right now, so I guess they're like the three things. We're looking for a stock market event. That's kind of when our eyes light up because we get opportunities. And what we're getting right now is the most juicy of them, which is a market-wide event. So the whole, like everything's kind of swept up in this market-wide sell-off. And why is that juicy? Well, it's because opportunities arise irrespective. So opportunities arise in stocks irrespective of what industry they're in. And the good thing about this is that if it's fears of recession causing the market to tank, well, that actually means there's not intrinsic problems in any of the companies on our watch list. I mean, sure, some companies, they might have a lot of debt and then interest rates go up and then they're in trouble. But just generally, if the market's going down because of fears of recession, then that's great because Apple's not selling less iPhones,
exactly. And the only thing I'll add to that as well is even if there was a recession and say Apple is selling less iPhones in for a year or two, that doesn't necessarily mean obviously that it's a bad business. It just means that it's just a bad business environment. But the fact that if they do go on to have a couple of bad years where sales go down 20% or something like that and profits go down a little bit, those stocks will go down too. The market is very short-term oriented. And so you can see which companies are very likely to recover and their customers are going to come back in full once, the recession ends. Those are where those opportunities will be. But yeah, as you said, even just like kind of fears of recession, nothing's even happened. Like there's nothing, there's not even any, there's nothing in the financial results that's even, happened at all. This is just market fear. It's just people thinking maybe something bad is going to happen.
Yeah. This is the best type of event because the event is people's anticipation of what's coming up is causing the market to tank, as you say. It's beautiful. There's not actually intrinsic problems with companies that we're seeing left, right, and center. It's at this point just sentiment. And even if it is economic conditions, well, that's just going to affect everybody. But that economic conditions, as we know, they go through cycles and they will continue to go through cycles forevermore. So it's quite an interesting one. But I think overall, what should we be doing in the stock market in these times? Well, you can go a couple of ways. I definitely don't think you should be selling good companies or selling your investments. So it's kind of like just keep holding, or it's potentially an opportunity to buy if a company you're looking at comes down to a price that you're happy with, or if you're just a passive investor, it's a great time to buy if you're going to buy the S&P for a long time in the future, if it's now 10% cheaper, then why not? It's a good time to be a passive investor and continue to buy those ETF shares if you're going to be holding for a very long time. And that's the thing, it's kind of the Warren Buffett logic. If you're like under 50, if you're going to be a net buyer of stocks over the medium to long term, you want the stock market to go down.
Yeah.
You don't want it to go up. Wanting the market to recover is basically just saying on Black Friday, man, I can't wait until these Black Friday sales are finished. I really can't wait until next week when I can pay full price for my iPhone again.
Yeah.
Yeah,
exactly. Yeah.
It's
yeah.
And the stock market's a weird place like that. It is the place where people run out of the store during the sale. They start putting the sale signs up in the window and all the shoppers get out of there, Yeah, it's very, very strange.
It is very bizarre. The one thing I will add to this, all of this would be, I think it's important to remember that just because a stock goes down in price doesn't necessarily mean that it's now suddenly one that you should buy. Like, if Apple is down 20%, it doesn't mean that it's 20% on sale. It could mean that it was really egregiously overvalued and now it's somewhat less overvalued, but it's slightly less overvalued. And so, yeah, I mean, if you're picking individual companies, you really need to know what the companies are worth. You can't just rely on, well, the market's down 10% or the market's down 30%, so I'm now going to buy all of these companies. You have to have a view on what the company is worth. But you obviously don't have to buy individual companies, and not only do you not have to do it, you probably, for most people, shouldn't. So it's even easier
if you're a small subset of people.
Yeah, if you're a passive investor, if you're most people and you are just a passive investor, it's even easier. You just keep doing what you've been doing.
Yeah.
You just keep buying.
Yeah.
And you can ignore all of this stuff. So. Yeah, that's what I would say at least.
Yeah, no, I definitely agree. If you're someone that's dollar cost averaging, just generally, maybe you take advantage specifically because you're staring at an S&P that's gone down by 10, 12%. That's a good potential. But yeah, I totally agree with what you're saying. If you're buying individual stocks, you need to have that rigid valuation method that you follow. So you need to check out Introduction to Stock Analysis over on New Money Education.
and use my link that's in the description of my YouTube videos so I get my commission.
That's funny. But no, you do need to have a rigid valuation method so that you do know. You need that context because you're right. If you're buying Nvidia because it's gone down by 10%, well, chances are you're still overpaying.
Correct. Yeah, exactly right.
But anyway, I think that's kind of all that I had to say on this stock market crash. Don't think we need to drown on about it too much.
You missed the part where you tell people to buy Trump coin. I missed that bit. Hang on.
Oh, okay. Oh, that's right. Down here. Yes. So now cryptocurrency update. I wonder what Bitcoin's doing at the moment.
The Bitcoin has been it's quite a way off its all-time high, or at least it was. The last time I checked.
Oh, yeah. Ever since my birthday, it's just been tanking.
Yeah. What's
down 22%?
Yeah, 22%. Wow.
22% in Australian dollars.
Yeah.
Have a look. What are we looking at in USD? Yeah, it's down like 20.6%.
Yeah. So it's taking a pretty reasonable hit.
It's time to buy. Isn't it, Hamish?
Yeah, forget everything.
That's what you told me.
Forget everything I just said. It's down 20%, so it's 20% on sale.
Mate, off air you told me that you're 10xing your Bitcoin holdings.
I'm loading up on Bitcoin. I'm gonna come out in a couple of years and say, I actually don't own any
you
stocks.
Suckers, I told you so.
No.
You had to listen to this podcast. That's the only place you'd hear it.
Yeah, exactly.
All right, we're waffling. Time to bounce.
Yep, let's go.
We got some car racing to go and see.
Yep, let's go watch some vehicles.
From. I'm going to the automobile race today. Are you coming along as well?
I will be there.
Oh, yes.
I will be there. Yeah, we should stop waffling.
I'll
Thanks,
be-
everyone, for tuning in this week. We will be back next week, as always. And thanks, Brandon, for joining me. And thanks to Seeking
mate.
Alpha for sponsoring this episode. And
see you in a few hours.
You know, what's that?
I'll see you in a few hours.
I'll see you in a few hours.
I'll see you guys next week.
See you later, guys.
See you guys.